the banks do have exposure to commodity lending, but if you go through their balance sheet in Australia, Europe and the US, the size of exposure to commodities and oil and gas is on average between 3 to 6% of their total balance sheet. So from our perspective, that's a very manageable risk. And where the banks have lent to is more particularly if you go to the banks in Europe and US, is been to the big oil companies and the vertically integrated oil companies. So therefore, their exposure is to higher credit risk companies. They're not directly as much exposed to exploration companies. How exploration companies funded over the last 3-4 years has been through high yield debt markets in the US, which are not really where the banks play in. So therefore, we think the exposure and the credit cost that will come out of this downturn in oil price is very manageable for the banks, and even at peak levels, it'll have a very small impact on their earnings. We think the market is just worried in general that this will have a contagion effect on the rest of the financial system. We just don't see that happening, and people use the analogy, look, that's what everyone said about subprime loans, that's what everyone said about mortgages, that the banks have low exposure. To put that into perspective, the banks had 30% exposure to subprime loans at the peak in 2007, before we went into the GFC. The exposure to total oil and gas high yield lending is only 2%. So that gives you a perspective that maybe there is a risk, but the size of the risk is significantly smaller than what people are worried about. Well, if you look at the capital base expansion, it's been roughly around 10%. So let's put it on, it's around 10% dilution of the share count. So if you say from peak to trough, it's gone down by 30%, 10% can be explained by the fact that they had to raise more capital. There is, out of that 20%, some percentage due to fears from the market that the RBA will again increase capital, again force the banks to raise capital. We think that's unlikely, but there is certain aspect. But the bulk of the decline is general fears that the macro in Australia is deteriorating further, and that the problems in China will have a significantly bigger impact on Australia going forward. Again, that's something that we don't think will happen. And it's the problem aside is look at the commodity exposure, look at what's happening on the commodities side. Well, the commodity slowdown has been happening for 3 years. Commodity infrastructure spending has been coming down for the last 3 years. So the bulk of the impact of the slowdown in commodities has cycled through all the mining services companies and all the other companies that the banks lend to. So we're in probably the last few innings of that slowdown. We're not at the start of it. So to us, the market is acting as if we're at the start of a commodity slowdown. We've been in there for 2 years. So the banks have actually cycled through most of those issues. We still think there is downside, but the banks can manage this downside through increase in mortgage rates, and they're well capitalized enough to protect their dividend. So that's why we don't think the banks are at as much risk, and we think the market is overreacting.